Hello traders. Now there's been some key pivotal learning points in my 3 decades nearly of trading and financial markets. Lots of experience and other skills, qualifications gained, but 3 really important ones to me and it's helped me get to where I am today was 1, learning technical analysis, 2, learning coding programming, and 3 is what I call game theory. It's a big concept out there. It applies to almost everyone. We use it every day, but if we focus in on trading, it can really transform your trading, and it did for me. It gave me a different mindset, a different process, different way of thinking and working, and like I said, you can take away some of the concepts, all the concepts you can learn it yourself. It's a very deep concept, and for anyone really interested, I've got this book here. It's called Theory of Games and Economic Behaviour by John von Neumann and Oscar Morgenstern. Brilliant. That's where to start if you really want to get into game theory. But I'm going to try and give you some examples of how you can apply it to your trading. 24, in fact. But also, before we even get to those, we've got to talk about what game theory is and try and cement the idea at a higher level, so you can understand how to start adding in game theory to your trading. So with that, let's get into it. If we could bottle down into just one sentence what game theory stands for, is it's basically the study of strategic decision making, analysing how participants and players make choices to maximise their outcomes in competitive situations. So as you can well imagine, that is every aspect of our life, whether it's watching a football game, betting on that, interacting with your family, or like we're focusing on here, trading. Now, like I said, it really is in every aspect of your life, and you'll see it played out in economics, politics, psychology, and trading. And we're trying basically just understand the behavior in strategic interactions. We're looking for an edge by our analysis of whatever we're looking at studying, so we can then apply that effectively, profitably in the world of trading. So there are 4 key concepts that we need to know about, as you can see in front of you here. First of is understanding the players of our analysis, the individuals or groups making the decisions in the game. Then the strategies, the possible actions or decisions available to each player. Then, the outcomes of payoffs, or the risk rewards received by the players based on the strategies chosen. And then finally the games, the structured scenarios where players interact, including rules and possible outcomes. So let's look at 3 key types of games involved in game theory. The first one there, cooperative versus non-cooperative. Well, cooperative games, that's where players can form alliances and negotiate collectively. Non-cooperative games, players act independently without collaboration. So a bit like trading if you're on your own as a retail trader. And then we've got symmetric versus asymmetric. Symmetric, where players have identical strategies and payoffs. Asymmetric games, players have different strategies and payoffs. Already we can see, we're building up the personality of a trader. We got, non-cooperative games and asymmetric games. And then the third one, well, that's zero sum versus non-zero sum. Zero sum games are where one player's gain is another loss, and non-zero sum games, all players can benefit simultaneously or incur losses. So trading, I suppose, a bit of a blend of both of them. I also want to share with you 4 key principles of game theory. The first one is the Nash equilibrium. Well, that is a situation where no player can improve their payoff by unilaterally changing their strategy, and it represents a stable state where players' strategies are optimal given the strategies of others. And then another key principle, dominant strategy, a strategy that always provides a better outcome for a player regardless of the opponent's strategies. Now, I'm just giving you a high level overview here to give you some idea of how game theory thinks and works. All of these you can drill down into a lot more detail. There's a lot more to take from them and understand if you really want to become an expert in game theory. And the other two, well, we've got the Pareto efficiency. It's a state where it's impossible to make any player better off without making any other player worse off. And then the mixed strategy, where players randomise over possible moves, assigning a probability to each strategy to keep opponents uncertain. I suppose a bit like poker. Right, I've got a handful of classic game theory examples for you now. You may have heard of them, you may have studied them in the past, but when you're going through these now with me, try and think how you can apply them or think about utilising them in your trading. Now, the first up, the prisoner's dilemma. Two prisoners must decide whether to cooperate, stay silent, or betray and confess. You can picture them, the two criminals arrested, put in two different holding cells, interviewed separately. Are they going to stay silent and work together as a team, or are they going to betray and confess? The best collective outcome is cooperation, but individual incentives can lead to betrayal. An example of this from the world of sports, doping. Athletes decide whether to use performance-enhancing drugs or not. If everyone stays clean, it's fair and it's a level playing field. If one cheats and the other doesn't, then that cheater gains an unfair advantage. They take the glory so long as they're not caught out, but like I said, it gives them the unfair advantage. So what do? Stay clean or cheat? Then we've got the hawk-dove game. Now, if you're into following your interest rates, the Fed, then this one's right up your street. Well, this model conflict and cooperation where players choose aggressive hawk or passive dove strategy. So when you hear them saying, the Fed's hawkish, they're more aggressive on interest rates, and vice versa. There, the game explores the balance between conflict and sharing resources. A real world business example of this, well, maybe a firm entering the market can choose how aggressively they're going to go in to try and capture market share. They're going aggressive, they're going hawkish. If they want to coexist with established firms, be a bit more passive, then they're going to go the dovish approach. Aggressive entry also can lead to price wars and conflict. Then we've got something called the ultimatum game, where one player proposes a division of a sum of money and the other player accepts or rejects it. Rejection means both players get nothing, highlighting fairness and negotiation. Here's a really obvious example of this: divorce settlements. One partner proposes division of the assets and it's up to the other to accept or reject, negotiate. Rejection can lead to costly legal battles, and it emphasises fair offers and, like I said, negotiation and settlement process. Another example now called the stag hunt. Go back in time. Two hunters, when they're out there choosing to hunt a stag together, it's going to require cooperation. Maybe they have to set the traps together. One coerces the stag into a certain situation. Or individually they could hunt rabbits alone. The upside to working together, the stag, if you capture one, is going to create a higher reward. But the downside to that is, it's going to require trust and working together. Now this one, the battle of the sexes. Here's some examples for you. Choosing dinner. Couple decide, between going to a movie or sports event, but both prefer to be together but have different preferences for the activity. Or take it to a business situation, marketing campaigns. Departments in a company decide on a marketing strategy. Each department might have a different idea. Maybe one wants to use Facebook, maybe one wants to go on the TV. But in the end of the day, it needs a unified campaign for absolute success. And before we move on to the world of trading, I wanted to just give you 5 further, so I call them fun examples of game theory in action, stuff you might have come across or play with in your everyday lives. Again, just to cement the idea of game theory and start you thinking along those lines. Now over here in Europe, we just had the Euro football tournament. Unfortunately, England lost. They didn't lose on penalties, which makes a change for them. But got this example here, penalty kicks in football. So the overview of the game, the player, the players are the person taking the penalty and the goalkeeper, and the penalty taker, the kicker, can have a choice of where they want to aim. When taking that penalty, they can go left, centre, right. It's really up to them, or they can blast it over and miss altogether. So what's the payoff here? If the penalty taker scores in the right direction, they get the goal that they want. They are in position A in the penalty shootout. The payoff to the goalkeeper, if he saves again, puts his side in a stronger position as well. And what about in the real world there? Strategy wise, both players use mixed strategies to keep each other guessing. The kicker may randomly choose their direction based on probability, and the goalkeeper does the same. If you actually watch or go behind the scenes in these football teams now, they actually watch all the video analysis of which way the goalkeepers move or the strikers kick. They work out the odds, and the players know it. They're trained into knowing which way these footballers are likely to kick the ball, or the goalkeeper is likely to move in a certain direction. How about that old favourite game, the rock, paper, scissors? 2 players, and as we know, each player can choose rock, paper or scissors. Payoffs in this game: rock beats scissors, scissors beats paper, and paper beats rock. And the real world thinking of this, players often use mixed strategies, avoiding patterns and trying to predict the opponent's next move. I suppose the fun side of it is it's fast, simple, great for friendly competition, and helps settle often quick arguments or decisions or disputes, as you know. But again, think of it how trading works. Think about mixed strategies, patterns, that sort of thing. Now, I've suggested in other videos that if you learn poker, you can also apply that thinking, that game set skill to the world of trading. The two go very nicely together. Now, poker, the overview. There's multiple participants. In Texas Hold'em, 2 to 10 players typically. Players can bet, call, raise or fold. Payoffs. The best hand wins the pot. But players can also win by bluffing others into folding. So you can start to see how it, trading is a very similar thought process. And in the real world, players use a combination of probability, psychology and game theory to decide whether to bet, call, raise or fold. What if you applied that to the world of trading? That simple process. You're looking for that edge. You want to increase your chances of winning. Think like this poker player, this game level of theory. Fun aspect of it, the element of bluffing, reading opponents' behaviour, adds a psychological dimension to the game, making it highly engaging. But as you can see, if you understand the world of game theory, you can also improve the psychological aspect of you playing poker, and again, relate that to trading. You can improve your trading psychology as well. So here's another fun one for you: auction bidding in fantasy sports. So the players are participants in the fantasy sports league, and the strategy behind it: each player bids on athletes to create their fantasy team, whether that's American football, soccer, call it football, whatever it is, baseball. Payoffs, the team with the highest performance based on the athlete's real world performance wins. So strategy here, players must decide how much to bid on each athlete, balancing the value and the budget constraints. Predicting opponents' bids is crucial, and the fun aspect, the competitive bidding process and strategic planning involved in assembling a dream team make it a exciting, thrilling experience. And another obvious one, horse race betting. So the players in this game, well, they're the bettors at the horse race, and the strategy behind it. The bettor chooses the horse to bet on and how much to wager, and the payoffs. Winning bets are paid out on the odds, which fluctuate based on the underlying horse and the amount of money bet on each horse. And the strategy there, bettors analyse past performance, track conditions, jockey skills, consider the betting behaviour of others to identify value bets. Fun side of it, combination of analysing data, predicting outcomes, and the excitement of watching the race unfold make it a popular betting activity. But you add the poker and the horse betting together, those concepts, those ideas of analysing, working out how the games work, put them together and apply it to trading, and all of a sudden you'll start to see your results improve massively. So at this point, I just want to summarise that the examples, what we've covered off so far, just shows you how game theory concepts like mixed strategies, probability, psychology are integral to fun and strategic games in sports and betting contexts. But I'm also hoping that you're starting to see how it could be used in your trading highly effectively. As it says there, game theory concepts apply to various strategic interactions. Trading's easily one of those, helping individuals and organisations make better decisions. That's what we're looking for in our trading, by anticipating the actions and reactions of others, whether it's a certain market, an economic bit of news, whatever. You can start to see how game theory can really impact and improve your trading. And if I was to summarise how I think game theory can help you in your trading, well, I think it aids smart thinking, because you're starting to think outside the box, looking for angles in to improve your results. It helps you create strategies. It helps you create a plan, which is essential for trading success in anything really. Better risk management. You're thinking of the risks more, how you can manage them, how you can optimize them and improve your results that way. And also, I think quite crucially, it aids trading psychology. It's going to create a more disciplined, consistent, confident environment for your trading. You're going to create processes, formulaic approaches that you can apply. You're taking out the bias, the human bias from your trading, which is essential for longer term success. But more importantly, it's going to give you that edge, and the edge means mathematically over the long term you're going to be a winner. So now I've got 24 examples for you, bumper amount of examples to get you thinking about how to use game theory in your trading. If you want to get into more of the game theory, got a new traders club via the YouTube channel at the moment. I put information about that in the description below this video, plus also a video at the end you can watch. And inside the group we're going to talk a lot more about game theory, utilise it a lot more, get into the detail. But also as the channel progresses and builds out, if I get individual requests, I can build out further detail and comments around this specific examples, and also show you how I utilise it. So I've tried to put a blend of examples together that focusing on retail trading, professional trading, an outside view of the world of trading, just to, like I say, get you started. Now, first one here, strategy one, crowdsourcing market predictions. Now, the idea behind it, retail traders analysing data and sharing predictions online. So you could use platforms like forums, social media to gather collective insights. For example, Google Trends. What stocks are trading now, And by understanding how the crowd is likely to act, you can anticipate market movements and make better informed trades. Obviously, you've got to test that information, back test it to see whether you've got an edge there, but it's certainly a start, into finding out, for example, like I said, stocks that are moving, stocks that you wouldn't normally find, by using stuff like social media, all those type of filtering tools. Number 2, the hot hand fallacy. Traders experiencing a streak of successful trades. Now, in my experience, a lot of traders, even professional traders, believe that their luck's going to continue. Often it doesn't. You've got to recognise the cognitive bias and avoid overestimating your future success on past wins, making more rational trading decisions. For me, that comes around measuring and capturing your trading results, so like your risk return, risk reward, those type of numbers, win-loss ratios, the statistics that are going to help give you that knowledge. Number 3, loss aversion and risk management. Traders reacting to losing trades. How do you react? Retail traders tend to fear losses more than they value gains. So again, like the previous number 2, it's knowing your stats really, to take away that human bias in getting out too early. If you have a strict process plan in place, rules around getting out of trades, the strong risk management process, trade management, stop losses, all of that lot, it's going to help you make more balanced trading decisions. So just 3 examples of quantitative stats you could use in processes in that analysis. The Kelly criterion, fabulous for knowing how to scale up winning home run type trades or strategies. I'll put a video that I produced on that at the end of this video you could watch as well. Other concepts like risk or ruin, Sharpe ratio. You instantly, especially if you go and work in hedge funds, Sharpe ratio is very popular. You can instantly give away whether your strategy is good or not. A classic, this one, number 4, herd behavior in stock movements. Large groups of traders buy or sell simultaneously. Herd behavior, the retail traders often follow the crowd. Is that the right thing to be doing? Gordon Gekko in his films says sheep get slaughtered, and often you can be on the wrong side of following the herd behavior. So you've got to be able to identify bubbles, market corrections, and position yourself advantageously. Number 5, anchoring bias in price targets. Traders setting price targets based on initial prices. The anchoring bias. Retail traders frequently anchor to initial price points. Be aware of this bias when setting price targets or stop loss orders, ensuring your decisions are based on current market conditions rather than past prices. Now, this is one of the rules teach you in technical analysis. Beware the round numbers, psychological support resistance zones, and you can pick that up by learning technical analysis. If you don't have access to in-depth market flow information, technical analysis is a very good tool for seeing where the numbers are to avoid those biased areas, so you can come up with your own. Another old favourite, number 6, the gambler's fallacy. Traders expecting market reversals after trends. Retail traders often expect that past events will affect future probabilities. You've got to understand this fallacy and avoid making decisions based on the belief that markets must reverse after a trend. And again, technical analysis helps you out very well here. Follow the rules of your trading plan. Number 7, understanding the paradox of choice. Traders overwhelmed by too many investment options. Sometimes retail traders can become overwhelmed. Simplify your decision-making process. Narrow down the choices. Maybe focusing on just a few markets rather than many markets. Become an expert in a certain field. Focus in on the high-quality trades rather than the volume. Number 8, utilising stop-loss orders effectively. Sort of going back to the risk management concept. Traders setting and adjusting stop loss orders. I would say try and make this as consistent a process as possible. Make it as formulaic as you do getting into a trade. Game theory can help you optimize stop loss levels. You can analyze market conditions, trader behavior. You can set stop loss orders that minimize losses while avoid premature exits. So this one, number 9, I've built around initial public offerings. That's IPOs, when shares go public, stock goes public in a company. It's called a winner's curse in auctions. Something to watch out for and think about. Retail traders often overpay in auctions such as IPOs or bidding for limited assets, maybe illiquid stocks. Use game theory to avoid overbidding and ensure you're not paying too much for a position. And a bit more about auction theory using the IPO. Again, the auction process and bidding strategies this time. When a company goes public, the IPO process often involves auctions. So this is more about understanding the process that you can develop a strategy for bidding on new shares to maximize your investment. Now, number 11, something I bang on to all new traders, even experienced traders who don't do this either. Time consistency in trading plans. Traders creating and following a consistent trading plan. It's all about time consistency, sticking to that plan, developing it, sticking to it, giving it a chance to work. Often people tinker, change, go off on tangents, apply the human bias, and it all comes tumbling down. You've got to, stick to the rules. Ensure that your short-term actions align with your long-term goals. Get those impulsive decisions out your system that could derail your strategy. Number 12, understanding market microstructure, detailed market order books and trade flows, understanding how the market works, whatever one you're looking at, whether it's Forex, stocks, futures. If you can understand that, by understanding the mechanisms of how trades are executed, you can give yourself an edge. You can use game theory there to predict order flows and liquidity changes, build models around it, allowing you to place orders more effectively, especially if you're a scalper, a day trader, that could be crucial. So a couple now on algorithmic trading. Number 13, algorithmic trading game theory, high frequency trading platforms and algorithms. These algorithms can be designed using game theory principles to execute trades automatically. They can obviously react far faster than human traders, capturing opportunities as they arise. So maybe a skill you could learn to improve your trading is automation, systematization, and maybe even getting into the world of computer programming. Number 14, also on algorithmic trading, but this one, evolutionary game theory. Remember, your idea will change as time changes. It needs to be worked on, developed, so you don't lose that edge. So by applying evolutionary game theory, you can develop adapted algorithms that improve over time and always keep you one step ahead of the curve and still churning the profits. Now back to the idea of the Nash equilibrium in market. Maybe this one's a bit more specific, but you can also use it as a helping guide for your own trading. Market makers setting bid-ask spreads, applying the Nash equilibrium to market making. Market makers can use this to set bid and ask prices that balance supply and demand, ensuring they remain competitive while minimizing risk. But for you guys, if you can understand how that process works, you can also start to understand order flow and gain an edge there. Now, number 16, signaling in insider trading. Traders interpreting insider signals. Now, what I mean by this is not doing illegal practices. It's really understanding, how traders, market users are sending their signals and translating what those signals and messages are telling you. So if you can understand signaling theory, you can interpret these signals and make informed decisions based on this activity, block trades, that sort of idea, order flow, technical analysis, sentiment, all sorts of things go into, picking up the flags that can help you, get an edge. Number 17, sequential games in day trading. Day traders make sequential trading decisions. Obviously, day trading, you're going to be doing trade after trade. You're going to be making multiple decisions based off your strategies and trading plan throughout the day. And you can use sequential game theory to help optimize that decision making process and taking into account the order and timing of your trades. Number 18, market entry and exit, timing. You can monitor those points. You can use game theory to predict when other traders will enter and exit. How can you do that? Maybe technical analysis, again, maybe some other fundamental or behavioral information you have. But by understanding their strategies, you can time your trades to maximize profits. For example, stop loss hunters, big hedge funds, pension funds, how do they operate? Can you play around what they do? The participants, the actual users, say in commodities, oil, when do people buy and sell? That sort of thing, helping your market entry and exit timing. One of my favourite tools are options, and if you use these strategically, they can also transform your trading. Loads of videos on my channel about options trading. Check them out. But using calls and puts, use it strategically. You can put combinations together to develop strategies, for example, straddles, strangles, and you can anticipate market moves without committing fully. They really are a great risk management tool, one that works on probability, statistics, definitely a skill worth learning. You can utilize the information the options market is showing you as well to help you, for example, trade US stocks. Number 20, identify market sentiment using all those tools that are available to you to measure sentiment, price action, technical analysis, the obvious one there. If you can identify the market sentiment, it's going to give you that edge. You can predict more easily the market movements. Other ones, studying news, social media, market reactions. You can gauge whether sentiment is bullish or bearish and position yourself accordingly. Like I said there, if you haven't got access to all this fundamental type data, then the best place I think you could start is by using technical analysis. Number 21, predicting reactions to news events, headlines, the impact they might have on stock prices, forex. You can track economic news events like interest rates, inflation, GDP, housing stats, jobs, that sort of thing that can seriously impact markets like the forex world. Predicting these reactions is going to give you that edge, how you can measure them into a more modelled approach can give you maybe even algorithmic approach can give you that positive edge advantage that you're looking for. Arbitrage opportunities, number 22. Different market exchanges, different price discrepancies, exploiting these differences. Use game theory to anticipate how quickly these discrepancies will be corrected and act fast to capture profits. A profitable strategy. You probably need a bigger pot size to profit nicely from arbitrage opportunities, but game theory can certainly help you there. Right, 2 to go. Number 23, diversifying your portfolio. You could build a diversified portfolio of stocks, bonds and other assets. I like to use preference function, which is basically weighing up the likelihood, the success of assets working together against each other and optimizing them accordingly. And I'm not going to exclude something in my portfolio just to diversify the risk. I want to get the winners. That's my approach to it, and I'll scale them up accordingly. But diversifying your portfolio, creating a mixed idea of strategies, that could be one way of doing it to minimize the risk. Different angles in on different markets. It doesn't have to be necessary you buy X amount of stocks, bonds, etc. It could be, like I said, different strategies on different markets. And apply this to your trading by spreading your investments across different asset classes to hedge against market volatility. So you've got to look for stuff like correlation risk, duplication of your trades, just common sense stuff there. Don't think as diversifying as just as clear cut as, like I said, just putting X, Y, Z in different buckets. There's a lot more to diversification and econometric theory that can help you boost your portfolio's returns. And lastly, number 24, market entry and exit timing. So a bit similar to previous ones we've looked at, but this is, with a different edge on, trading or traders monitoring these points, specifically using game theory to predict when other traders will enter or exit buy positions. But really this one's about understanding their strategies so you can time your trades to maximize profits. So there you go, that's my brief insight into what game theory is. We've gone into a bit of the background of it so you can cement the ideas in your head, and then we've then taken it into the world of trading, giving you 24 pretty high level examples of how you can put it, or start thinking of putting it into your trading. And hopefully you can see the benefits of using game theory and what sort of edge it would then give to you. Now, I promised you also in the video that I'll put a couple of videos at the end of this one, the one on the Kelly's criterion and our traders club. So if you have found this video interesting, want to learn more about game theory, we go into it a lot more heavily in the traders club, so I'd love to see you in there as well. But if you want me to produce any more content on game theory, let us know also in the comments below, and love to hear your theories and feedback. Do you use game theory? Has it given you the edge? What strategies do you run based off it? Are you a poker player? A horse bettor? That utilizes theories in both those areas into your trading as well. Like I said, love to hear from you. So if you've liked today's video, please give us the thumbs up. Don't forget to hit the subscribe and the notification button bell to receive future warnings, heads up of all the content that I will be producing. So those videos, they're coming up right now.